Extreme fear is creeping back into the market, and with 4 straight down days, could there be more to come? Today we discuss rates and whether we're starting to see the delayed impacts of higher for longer and what that might mean for companies. But what's really turning heads is solar stocks. It got hammered in the last 24 hours, and the big question remains, is there more to come? But with markets facing serious headwinds, we've reached a critical zone we've been speaking about. Are we on the edge of a colossal cliff? With yields topping 5% and with geopolitical tensions further escalating, we have a lot to discuss. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe and hit the notification bell. Let's get into it. It was a sea of red everywhere, led by technology. Some of the biggest names, Apple, Microsoft, Nvidia, Google, Amazon, Tesla, all slid, and almost every sector was red on the day, except for a small pocket in consumer defensives and healthcare. Looking at the weekly, Tesla was down 15%, absolutely crazy. Netflix was up 12%. We know why. Great earnings. Consumer defensives, you can see it was definitely a rotation into the sector right here, as well as energy, as market participants are just walking cautiously. Technology, I think, were the leaders in the move down. We saw Nvidia down 9%, as well as Apple, the biggest stock in the world. Microsoft did very, very well for the week, all things considered, but broad-based selling everywhere. So the sectors on the day, we saw that the sector total 1.26% down for the day. It was a massive risk off day. Consumer staples fared the best, energy fared the worst. They were the best for the week, so it was a bit of risk off, a bit of profit taking as well, you could say. Technology absolutely hammered on the back of Tesla, but all in all, it was just a risk off day across every single sector. Looking at these sectors as a whole for the last 5 days, gold miners right here, as well as staples and energy, performed the best. Solar got absolutely smashed, as well as rate sensitive assets, real estate, discretionary got smashed as well. You can see a couple other names here, mining, technology, financials, not faring too well for the week. Looking at commodities for the day, oil was up big for the week, but they did come down on the day. People were looking for safe haven assets and they moved into gold and silver. Silver up 2% for the day. Bonds, again, it was generally speaking, the entire yield curve did move lower, but if you look at the 5-day total of the yield curve, rates as a whole did move higher, especially on the longer end of the curve. And if you look right here, the last 5 days, the 10-year and 30-year outperformed. The 2-year was relatively flat. It did catch a bit early on in the week, but it was the 10-year and 30-year moving higher for the week, as well as the 2-year and the lower end of the curve just remaining flat, which means we are seeing the yield curve uninvert, albeit slowly. This was all of the companies that reported for this week. We had the big two, Tesla and Netflix, right there. And this is so far to about 20 to 25% of the companies have reported earnings, and 73% of the S&P 500 companies has beat estimates. Now, this is below the 5-year and 10-year average, but you have to consider the environment we're in. The last 10 years, the last 5 years has been a fairly low rate environment, and all things considered, this is a great number. Companies reporting earnings next week, we have Microsoft, Texas Instruments, as well as Meta, and a couple of energy companies here on Friday. So it's a big week for earnings. Now, looking at the S&P 500 as a whole, stocks above the 200-day moving average, it's only about 34% of stocks. So generally speaking, a lot of people would say stocks around right now, the S&P 500, if you look at forward PE, is looking good value. That being said, are stocks good value when you look at it on a risk adjusted basis? And there's a lot left to be desired. You can see right here that the S&P 500 current earnings yield in blue and the 6-month treasury earnings yield, treasuries now yield more than stocks. Cash currently yields more than the forward earnings of the S&P 500. And this is why I say you need to allocate some of your money to bonds and you need to allocate some of your money to cash. You do need to hold some stocks, find good names with strong balance sheets and allocate accordingly. Now, when is that cash yield gonna come down? Now, this is the Fed fund rate futures. This is the newest version of it, and we can see here that futures are pricing in one more rate hike during November or December. We were pricing in 3 rate cuts last year. We're now pricing in less rate cuts and a higher fund rate by the end of 2024-25, as well as rate cuts coming in April and May at the earliest. All subject to change, but that's what we have for now according to the futures. Now, why are we expecting less rate cuts? The US wrapped up its fiscal year with a budget deficit near $1.7 trillion, up 23%. And long story short, the US is spending more money than they're bringing in. And when you spend more than you make, you are at risk of default, and market participants are demanding higher yields for taking on these bonds. These bonds are now deemed as riskier, and they want a higher rate because they know that the US government is spending more money than they make. So OPEX week just wrapped up. We were looking at this stat saying it normally is a positive week, but it definitely ended in a negative week today. It was a 30 up versus 10 week. Now it's 30 versus 11 in the last 40 years. It was a pretty brutal week, but that being said, these are just recurring price stats that we look at. They work most of the time, but sometimes there's just no correlation. Let's have a look at some unusual options activity. We had the big three, SPY, IWM, and QQQ, all post some very, very big volumes, all above their 90-day average volume. 1.5 for the SPY, 3.55 for the IWM, and it's had large volumes over the last week or so, as well as the QQQ. 1.4 times 90-day average volume. They also did all post massive amounts of puts against calls, 736 million puts, 1.2 billion for the IWM, as well as the SPY, 1.64 billion puts. We saw Tesla in this area here as well, and just in general, it was just all of the tech names, they saw massive volumes because they are sensitive to rates, even though I do think most of these tech companies like Apple, Netflix, Microsoft have just great balance sheets. I don't think they're going to be as affected by rates as people think they are, but again, they're still up here. TLT, the Treasury bond, we've seen some very high volumes in that. A bit more on the call side actually. So moving on to volumes, we saw it was OPEX 46 million. We saw 43, and I said volume will increase. That's exactly what happened. 51 puts against 49 calls. You think based on how red it was, it'd be closer to like 54 on the put side. 51% puts, with the highest volumes coming in consumer cyclicals, financial services, and technology. That being said, pre-election year seasonality, we can see we are right here right now, and what history tells us is that we are looking forward to a Q4 rally. And as everything is setting up right now in the market, it looks like we are poised to do that, but it is going to depend on a lot. There is a lot of geopolitical tension stuff occurring. There's a lot of bond issuance happening too, so we're going to see how all of this pans out. But as it stands right now, we are poised for a Q4 year-end rally. And I have some stats here, especially for the Nasdaq, and we can see that from the October low up until year end, the Nasdaq normally sees a 9.5% return at an 88.5% clip. Up until the high in November or December, it's a 98.1% clip, returning an average of 13.1%. Based on the stats on 50 years of data, the Nasdaq normally returns 9 to 13% from the October lows to the year end highs. So that's what we can expect. We will play probabilities. It's more likely that probabilities are in our favor considering where stocks are below their 200-day moving average. We are quite oversold, but there are some headwinds. There are some headwinds that are making people nervous. Now, this is something that I posted on my Twitter, and go ahead and follow me on Twitter, guys, or X. And pretty much I said bears are in charge until the 19th of October. That's what we said. Time is not on their side. So we will be selling all rallies if the market is technically weak up until the 3rd of November. So up until the 3rd of November, we are selling all rallies. A face-ripping rally to occur on the 25th of October if bears falter. It seems that they haven't. So the face-ripping rally is going to start on the 6th of November. Okay, so from the 6th of November, that's when we can see bulls start to come into the market, and we could start to see them come in as early as the 25th. But from now until the 25th, guys, the next 4 or 5 days of trading, expect choppy action as well as possibly some downward momentum. Let's get into some dark pools. This was crazy. S&P 500 Trust, a ton of dark pools came in here at the lows. We also saw this print right here, which happened around here. So long story short, shorts came in here, took the price lower, and it looks like they covered their shorts in this area right here. So this is the Dow Jones, guys. This is the last 5 days. No big trades happened right here or here, but we did see huge trades come in here. So could these be buys? Could these be sells? Probably buys for the Dow Jones, looking for a year-end rally maybe, but yet to be seen what comes Monday. And this was the equal weight S&P 500. Have a look at this, guys. So this is the equal weight RSP, the equal weight, huge amounts of trades coming in here. Probably shorts. How do we know? Market sold. And then this year was probably people taking off their shorts, but it's very, very telling that I don't think all of these orders got covered. So very likely that we probably go lower on the RSP. And once we see a lot of these orders right here getting covered, that's probably when we could say, there's some form of a bottom forming, at least on the interim for the equal weight S&P. Thank you so much, guys. Please give me a like, comment if you like this video, share it around, subscribe to me. Catch you soon.